On January 1st, 2009, Cameron Inc. bought 40% of the outstanding common stock of Lake Construction Company for $910 million cash. At the date of acquisition of the stock, Lake's net assets had a fair value of $1,100,000, or let me read that the correct way, $1,100 million. The book value was 1,000 million, or $1 billion. Half of the book value and fair value of Lake's individual net assets is attributable to land, and the other to buildings. Lake's net income for the year ended December 31st, 2009 was $120 million. During 2009, Lake declared and paid cash dividends of $29 million. The buildings have a remaining life of 20 years. Cameron reports under IFRS and has elected the proportionate consolidation method to account for its investment in Lake. Requirement 1 asks, what would be the effect on January 1st, 2009 of the Lake investment on the following accounts on Cameron's consolidated balance sheet? Let's take a look at how we'll answer requirement 1. On the bottom left, you see a schedule of the fair value, assuming we owned 100% and 40%. They told us in the problem that of the $1,100,000,000 of fair value, half of it is attributable to buildings and half is attributable to land. So if we allocate the $1,100,000,000 as $550 million to buildings and $550 million to land, then if we take 40% of those numbers, we come up with $220 million for buildings, $220 million for land, for a total of $440 million of fair value. Since we paid $910 million for all of the common stock of Lake Construction Company, or not all of it, but we bought a 40% interest, what that means is the $910 million less the fair value of $440 million, which is 40% of the fair value, leaves us with an amount of goodwill to increase on our books in the amount of $470,000. So the net effect is, as a result of this acquisition, we will have an increase in buildings of $220 million, an increase of land of $220 million, and an increase of goodwill of $470 million. There will be no impact of using the equity method of investments. Next, we take a look at requirement 2, which reads, what would be the effect on December 31st, 2009 of the Lake investment on the following accounts on Cameron's balance sheet? And the only impact we get is a decrease in buildings of $11 million. And let me show you how we calculate that. We already determined earlier that the building fair value cost is $220 million. There's 20 years remaining life, so if we take the $220 million divided by 20 years, we come up with $11 million of depreciation expense, or increase in accumulated depreciation, that we're going to see for every year thereafter. Land is written on the books at $220 million. There's no depreciation or any other write-down of it unless there was some kind of impairment. And the same thing happens with goodwill, so it remains on the books at the same amount for 2009, barring any other information that tells us to do something different with us. So the only impact is buildings has a decrease of $11 million. Requirement 3 asks us, would Cameron's December 31st, 2009 retained earnings differ had it used the equity method versus using the proportionate consolidation treatments? And the answer is simply that the effect of the investment on Cameron's December 31st, 2009 retained earnings would not differ between the equity method and proportional consolidation treatments. Under the equity method, Cameron would recognize investment revenue based on its share of Lake's net income, while under proportionate consolidation, Cameron would include its share of Lake's revenues and expenses on those lines of the consolidated income statement. Regardless, the same total amount would be included in Cameron's net income, and it would get close to Cameron's retained earnings.